With that, introduce our panel here. By the way, my name's Jim Alerding. If you haven't sat in on one of my sessions, I've been doing this kind of work for close to 40 years now, and I have testified over 400 times, member of the Business Valuation Hall of Fame, and helped write the standards for any of you who were in the last session here. So that's enough about me. Lari, Masten, please tell us a little bit about you.
I'm Lari Masten from Denver, Colorado. I've been a member of NACBA since the late 90s, got my credential in the late 90s, and been involved. I recognize most all of you in the audience, and so I'm sure you don't need me to speak too much about myself. You're here to hear our responses to some of the questions that Jim has. So, TJ?
I see your friend, Mr. Senior, is over there to keep tabs on you. So.
He's going to be heckling the clown.
Well, he heckles me all the time. So.
That's his job.
TJ Liles-Tims.
My name is TJ Liles-Tims. I'm from Oklahoma City. I have a practice there. More than anything, honored to be up here with both Lari and Jim. My practice is primarily valuation and financial forensic oriented.
Okay, so what we're going to do is we're going to throw out some questions. In honor of Mr. Hitchner, I'll say too, please don't answer it depends. That's not a good answer that helps anybody who's sitting out there anyway. Might help you if you're dealing in a real situation. Okay, so we're going to throw out some questions. They're going to respond to the questions. If you have any questions that you want to answer or you want an explanation or a clarification on the answers, there are two mics. Please get up and speak to the mics because the people who are online cannot hear you unless you do. So first of all, I know that Neil Beaton today, Neil, are you in here? Guess not. Well, there you go. Neil was talking in part in his presentation on intellectual property valuations about forecasts and prospective financial statements, and that's one of my hot buttons at the moment. And so I want to ask both Lari and TJ, let's start with TJ, and ask when you're doing either valuations or damages cases where you need forecasts or something like that, how do you have the client do those? Do you intercede in those, or just how do you handle them?
Well, I've actually done it in both ways. My key thing in forecast and projections is variance analysis, looking at historically management's projections, their budgets. Are they in fact meeting the actuals themselves? If they are or within a margin of error, then I'm fine with relying upon those. At the same time, if I feel confident enough that I can justify on the stand a alteration to it, then I don't necessarily have an issue with doing that. I prefer not to. I would much rather not to, but if I feel that I can justify it, I will. With all that being said, the key, in my opinion, to forecasts and projections is benchmarking it to actuals.
Okay, and so but you do involve management
yes.
in most cases. Lari?
Yes, sir.
And I think to piggyback on that, I'm kind of in the same camp as far as it relates to, if you can test what management has done, if there seems to be some reasonableness along with it. But when it moves into me having shifted whatever they've done to begin with too much, I feel that you are in a sticky situation because you're basically opining to your own numbers at that point. I mean, kind of putting my old auditor hat back on rather than the valuation analyst, that if I change the numbers too much and it's so drastic, I can certainly, explain why I did it, but does it make sense? And as TJ mentioned, if you can correlate, use some statistics, look at, variables and how they've changed over time, then, management, if management's estimations or projections or whatever the hypotheticals that they've used, if those haven't come to fruition, then I think I have to do something. And then for that, then I can rely on professional judgment, statistical analysis, concrete things that show these things should occur, but it's a much more difficult place to be in as an expert when you're having to defend those.
Right. And I would agree with that. I always try and have management prepare the forecasts. I don't mind sitting down with them and helping them somewhat if they aren't in the practice of usually doing them. But I think they, as Neil said in his presentation, they know the business a lot better than the 20 hours I put into the engagement so far or whatever. And so it's better to have them do it. I really don't like when, and I've seen it, where valuation analysts come in and just completely prepare their own, based on their own thought process. I think that really is a dangerous practice. So, yes. There you go.
Hi, Garth.
Hi, Lari. That's sort of like a perfect world. There's a lot of people in this room that we don't have management prepared projections.
I understand that.
And Jim, this is a pet peeve of mine, as you said it was of yours. Our job is to develop the benefit stream. There are certain engagements that we are engaged in where historical information is not an indicator of the future. Our job is to determine that benefit stream. If management doesn't have projections, or those management projections are unreliable, or they are biased with regard to the party that prepared those, or has a certain bias towards the outcome of the valuation, that is not an excuse for us to say we cannot rely on the income method. It is our job to develop that benefit stream. And if we have to use forecast and projections, then it's up to us really to work with management to develop those if they're not capable. So I'm more in line with what TJ is saying in that, okay, we have to test those. We have to analyze those. It's ultimately, we're relying on that benefit stream, just like we're relying on the discount rate, just like we're relying on the growth rate. You know, ultimately, our opinion relies on those factors. And so therefore, I think we have that obligation.
Well, I'm not saying we don't. I don't think Lari was either. I try and involve management. It was what I was saying, to the extent that I can. Now, if I wind up moving the pencil more than they do, as long as I have their input, that's the difference. Now, I've also been involved in a lot of cases where management on the other side is not going to give you a thing, you know, but most cases you can work around that to some extent. You have anything else to say on that?
It just, a case that I had a few years back comes to mind where it was the perfect world, Garth, where I had budgets and forecasts, historical and, you know, perspective. And it was amazing how close management was able to predict what was going to happen. But in that particular case, it started off as a valuation issue, and it turned into a fraud issue because the CFO was going back and changing the budget numbers for the board meetings on a quarterly basis to show that he was meeting the marks. And so, and the way I discovered that was through running some regression analysis and some statistical analysis on, you know, why are the numbers so close together? I mean, it's just, I'd never seen spot on how good they could predict what was going to happen given economic changes. So I agree that the perfect world doesn't always exist, and especially in the really small, closely held businesses where you have one guy wearing 4 hats and you know, he's like, forecast. I'm an entrepreneur. I have a gut feeling where we're going to be, but don't ask me to prove it.
And I agree 100%. I think, again, it is our job. I agree with the gentleman who asked the question, to make sure that we have, to the extent possible, we have reliable forecasts.
Well, and I think that in addition to that, even if we don't have the projections, and I think that my 2 colleagues will agree that we have industry research that we can also budget to actuals as well. Mm-hmm. And so if we have some kind of a benchmark that, whether it's historically management's projections or maybe historically industry research, we then can take that exercise to walk through with management and possibly create or assist in projections.
I just wanted to ask you, how would you deal with that the perspective as you're testifying, now that they know that you're acting as management?
What was the last part? I'm sorry, what was the last
Yeah,
part of your
last point
question?
I
I
didn't get
missed
either.
that.
Asking, as a testifying expert, you go up now and you were more involved in the assumptions or the presumptions. How would you handle the cross on that?
Well, I think the cross is I think Garth gave us the right answer. You know, our job is to predict what's going to happen. Every valuation that we do, it's just a prophecy into what we think will happen in the future. And how you justify the forecast, if you have an implicit forecast that you have to create, is all based on the fundamentals of understanding the theory, the experience that you have, looking at the historical information that the company has had, comparing that to why did the company or management prepare the forecasts that they did. If you do have those and you're veering off of the company provided data, then why are they doing that? Why is there variance compared to the history? I mean, it's kind of facts and circumstances dependent. Is this a lost profit issue? Is this a business valuation? But I think in general, we have the answers to those cross-examination questions. It's not just my opinion, it's founded.
My concern is that you're advocating for your opinion, not the client's opinion. And if you speak to the client too much and you can be cross-examined where it looks like you're not maintaining your independence and your objectivity. So where's that line? Like, I agree with if we can find the statistical data and you regression it out and you put all your dates, but where's the line that you cross that when you're on the, you're up there and they love to say there's speculative nature in it to begin with and you're predicting the future, and now management wasn't good enough to even generate their own assumptions and they needed us to do that. How do you handle that as the person getting cross-examined?
Well, I think that's the importance of looking at it from the actuals to what has been projected. I mean, I would wholeheartedly agree that if projections are off tremendously and we rely upon projections, then absolutely we're being an advocate. But if the projections, the variance analysis is within a margin of error, I don't think that we're being an advocate. I mean, because clearly CFO, business owner, whomever, assuming there's not fraud involved, is doing a good job of projecting what could occur.
Well, they should know best. They're in
Right.
the business. But to answer your question from my perspective too, if you believe there are changes, it's like anything else that you provide in the valuation, all right? The same thing could be said about the discount rate. And Jim Hitchner has a presentation on rigging evaluation. Errors in and rigging evaluation. And the point is, you can go through the whole process and you can rig it. So you don't have to rely on forecasts to do it. But if you do make changes and you do have your own opinions on assumptions, et cetera, and why, then you do like you do with any other piece, you support it with your opinion. And that's the best you can do. So let me ask one more question related to that, and then we'll move on to another topic. If you get the forecasts down to a point where you feel, and management agrees with you, that you have the most likely result in the future. In other words, that's what you believe you have settled on, is this is what the most likely case to happen is going to be. What do you do with your discount rate?
Well, I think if you're handling the risk in the benefit stream,
Right.
then you don't have to deal with, you shouldn't double dip. You shouldn't add
That's
any
right.
additional
You
risk
shouldn't.
factor into the discount rate. I mean, you should,
So what do you use then, a risk-free rate? Concept 7 says you use a risk-free rate.
well, so if you're looking at a damages case, is that what you're?
No, I'm just, no,
anything.
let's look at evaluation.
Okay, well, you have
Let's
a
say a
risk-free
business
rate.
and divorce.
So you have risk-free rate, you have equity risk premium, you have your
Well,
size
why?
premium,
If you've
all of
taken
that.
the risk out in the forecast.
No, I don't think when you're looking at management's forecast and you think this is the right number, you still have to look at the risk of the outside exterior risks of that business. Maybe I've identified what we really think the benefit stream is going to be. Cash flows, cash is king.
Okay.
But there's still unknowns that it's impossible for us to predict. We're not that smart.
Okay. TJ?
I tend to agree in that there are still inherent risks, whether it is from maybe management's perspective. I mean, there are still operational risks,
Industry risks, economic issues.
that I don't think that even a projection, we may agree with that projection, but there are still things that could occur that causes an increase in just the risk-free rate.
Good answers. So following up on my last session here, from each of you, do you use calculation engagements? Do you have those in your practice?
Do you want to start or you want me to start?
Sure, I'll start. It depends. In litigation engagement.
No, you can't say it.
Okay, sorry. Oops, sorry. Sorry. In litigation engagements, no, I don't. I will try and get an attorney to understand the difference between a calculation engagement, or I do get the attorney to understand the difference between a calculation engagement and a conclusion of value, because I do not want that calculation number getting out and then exposing me on the stand. So I stick with a conclusion. A calculation outside of litigation, I don't have an issue with it. But I make sure and explain to the client what that difference is. And it could be times when Lari and I teach the report writing class together. And one of the things that we try to get candidates to understand is writing the report to your audience. And if it's a CFO of a company, he probably has a pretty good idea as to what maybe the best method may be. Does that mean that we don't provide our opinion? Absolutely not. But he's going to have a pretty good educated, pretty good knowledge as to what may be the appropriate method. So maybe we go back down a calculation that says to utilize the income approach, utilize this cap rate, utilize a cap of cash flows, and and go down that route.
All right.
And so I'm not as opposed in a case that I know, somebody's filed a complaint to issuing a calculation, but it's at a certain level in that engagement that I'm willing to do that. And that would be, hey, we're preparing for mediation. Can you just, we're not ready and we're not prepared to create the budget for you to do a full valuation, but we just need to know in the ballpark range. And you guys know, you guys get these calls all the time. It's like, okay, right. So then I give you a ballpark range and you're paying me, 20% of the fee that you'd pay me for doing the regular valuation work. And then you get that in the client's head during mediation. And then I come around and I charge the extra 80%, and maybe I come pretty close to the same number, and it puts you in an awkward position. But I think that in mediation, it's reasonable because it's negotiations at that point. In M&A, I think it's reasonable because it's negotiations at that point. So I think the purpose of the calculation is really what determines whether or not I feel comfortable issuing one. And then I still feel, if we look at the NACVA's professional standards, in the preamble of our standards, professional judgment is key. And just because we're doing a calculation of value doesn't mean we're not
That's correct.
applying professional judgment. It's, okay, we're just going to do the market approach, but we still have to apply, professional judgment in selecting the database that we use, selecting the transactions, how we apply it. And so I don't have a knee-jerk, no, I'm never going to do a calculation reaction.
Well, as I mentioned in the last session, for those of you who weren't here, I won't use them in litigation, but I write an engagement letter that includes both cases. And I say, I'll provide this calculated value, and I explain what it is, and I sit down with the client face to face and explain it. But if you don't settle it and you say that you want me to come and testify in court, then I have to bump it up to the valuation engagement, and that's what this is, and that's different from the calculation, and that's the way we do it. And I've never had a problem with that.
Yeah, and I've never been on the stand after we've tried to go through mediation, and I've gone on and done the full analysis and maybe come up with a distinctly different opinion. I've never had a problem defending the fact that I had another number at the beginning during mediation because I didn't do all the work. I didn't have all the data, whatever the reason was that caused the the, calculation come about, I've not had an issue with defending that.
Okay.
We do have a question.
Yes, hi. Jim, after your presentation that ended a little while ago, I had a very energetic conversation with a colleague of mine who is a friend and hopefully still will be in a few minutes. But something that he said was that he said, I've heard and I've talked to a lot of people who've said this, and there was some instructor here today that said this, that if you are doing a calculation of value, then you can't use any judgment.
Well, no, that's not the case, because if you read the
Could
standard,
you
the
repeat that,
standard
please,
says,
for this individual, my
standard
friend?
says that you are doing two things that require you to follow the standard. And that is, you're applying valuation approaches and methods. You're clearly doing that under a calculation, right? And you're using professional judgment. So you're doing that too. So yes, you do apply professional judgment when you're having a calculation engagement. So if my engagement says that I'm going to do the comparable transactions method, and that's all I'm going to do, and therefore it's a calculation, don't I have professional judgment there? I have to decide which transactions to select.
Well,
right?
I fully agree with you. I think there's some confusion about this issue, and maybe for mostly the new people, and my buddy is not a new person, but, when it has the word calculation in it, but we have to remember there's that exception that if we're acting as a calculator, then those standards don't apply to us.
Right, that's different.
That's different, but the same root word is in both places, and maybe that's some of the confusion for whoever it is that, feels that we don't have to
Well,
use.
clearly you do provide professional judgment in a calculation engagement.
But professional judgment is not a replacement for a conclusion or an opinion.
Right. Thank you.
No, it's not. Okay, let's move on to another subject here. As it relates to discounts for lack of marketability,
You wrote the book. How are we going to answer your
you
question?
can answer the question. I've already talked about it enough, so. Okay, so what's a
Sorry, I felt like singing.
You're pretty good at that.
We're getting music here. What databases, studies, or models do you use? TJ, I don't know why we're getting music here, but we
I'm
are.
perplexed at my singing right now.
Yeah.
Pretty good at that ventriloquist.
Where's your guitar?
Okay, I'm sorry. Can you guys hear me still?
Our mics are still on. I know that.
Are they
Yeah.
still on? Okay, I'm sorry. I really.
That's all
didn't
right.
really
What in determining a discount for lack of marketability, what databases, studies, and models do you use?
Well, definitely look at.
You're gonna get louder.
I know. I feel like I need to start standing up and kind
Yeah.
of doing this number.
Is that your guitar back here? Well, let's hope we get.
We must have asked this question 1,000 times, TJ. Can you answer the question?
Absolutely. I know. I kind of feel like I need to put my arm around Lari or something.
I bet they turn that on for the reception. It's a little too early.
Yeah.
That is a really hard question to answer with the music in the background.
Wait for a minute and see if.
Yeah.
Yeah.
Let's
I don't know. Crazy.
I'm sure you guys hear, but it feels like there's a speaker in our left ear right
Yeah.
here. It's very loud. Okay, there we go.
Okay.
All right.
Okay. Okay, so in terms of the discount for lack of marketability,
There it goes again.
and here it goes again.
Encore.
Sorry, I'm not going to do it again. So the various things that I look at are the restricted stock studies. Obviously, we have to look at that. Databases. I guess it's now the Stout, Rices and Ross's marketability databases.
Yeah, Stout Reese's.
Do what? Okay.
All right, we'll just wait until they figure out how to turn it off. It's crazy.
I'm gonna text Brett.
Well,
Hey Brett, can you turn off the Adele music?
text Brett.
Yeah, I just texted him. Probably should text Brian too, but Brett's the one who knows how to get it turned off.
Do what? Yep. Did you text Brian?
I didn't text Brian. You text Brian, I got Brett.
Oh, this is crazy.
Hey.
There we go.
Oh, okay. All right.
It was a hotel issue. They're trying to fix it. Okay.
I'm sure it was.
That was the
Okay.
excuse I gave.
Okay, studies, restricted stock.
Okay, restricted stock studies look at the Stout database. Used to be the FMV database. The key thing for me is breaking down into the different transactions themselves, especially when I utilize the database. So many times now, as we as practitioners know, practitioners tend to take the simple average. Based off Mandelbaum factors and other components, breaking down each of those transactions to come up with one that is more similar to my subject, more similar to the transaction that is at hand, is how I personally develop the D-line.
Okay. Lari?
And within the studies, you can look if you do some more research now. As maybe just 3 months ago, I was trying to locate the actual studies, and I found it very difficult to find the actual studies to read. So we have these summaries of the studies that we use to then parse out what we need. But within the different studies, you can pick, where the profile of the business that you're valuing, what studies fit within that profile. Do you have studies that only look at profitable companies? Do you have studies that, are in certain areas, manufacturing, whatever, and try to select those instead of looking at all of them across the board, across all the years going from the 1960s into the 2000s. I think that smears what you're doing a little bit. And so I try to, based on the company, fit in with one or two of the studies that make sense. And then again, using that as a benchmark, and then, adjust that with the Mandelbaum factors, assuming that's an IRS issue. And then backing that up with data that we have, hopefully in the analysis that we've already done, if that's under the income approach, maybe using the completed transaction method and looking at the differential between something that if we have all private transactions in the completed transaction method, then those are theoretically already adjusted for what we call this discount for lack of marketability because it's a private company. So you can adjust, you can look at the comparative between your results of one method and then the application of a discount, a subjective discount under another method, and see if they correlate.
Do you use the Plurus database at all?
I have used that in the past. In the recent years, I've kind of shied away from it a little bit because there's just certain aspects of it that either are too difficult to explain to a trier of fact, depending, like in litigation, or that more often than not just make me uncomfortable with pure reliance on that as one method. But I think if you were to use the Plurus, you could use restricted stock studies. I mean, there's, we have the IRS Job Aid that had numerous studies in it and different ways of coming up with the discounts, the creativity of using option models and all of those things. I think, the more we try to found discount for lack of marketability in a empirical manner, I think the further away we actually get from trying to predict what the real discount should be.
Okay. Use the pre-IPO studies, either one of you? Nope, I don't either.
No.
They're not reliable, I don't think, in doing this. Okay, pass-through entities. Where do you stand on that, and what do you think the future is in terms of valuing those? Who wants to go first? TJ?
I'll go first, and I'll take all the beer bottles thrown at me. I have been one to, as of recently, utilize Pratt and Grabowski's book, The Cost of Capital, and how they adjust that in through the discount rate. And comparing apples to apples and looking at, okay, what's the comparison with the determined Duff & Phelps cost of capital to an after-tax number, and then so basically calculate for my subject company what that estimated after-tax number would look like, and then adjust the discount rate to that pre-tax number. So that's the more and more I have looked at, and that is an exercise that I will be the first to admit has been probably within the past 12 months that I have gone to that, as the more and more I've researched. In this entity, in this subject myself, I think it's incumbent on us, especially in litigation, to be able to justify what we're doing and be able to explain it. And I think that so many times we try to adopt one method and don't truly understand that method. And so I think it's key to truly understand how to make those adjustments before you just run out and adopt that.
And I think within that, I think the danger, I'll just argue with you, is when you're adjusting that discount rate, you know, what corporate tax rate are you using? I mean, what I see is a lot of people use a 40% discount rate, or a 40% tax rate. And then if they have state income taxes, they pile that on top of it. But where do we get those equity risk premiums or for corporations who are not paying at a 40% tax rate? I mean, their average tax rate is at 19%. And so it's not just flat adjusting either way on the discount. If you're trying to get a pre-tax discount rate, using 40% I think is an error, and maybe using 19% is an error. But on the same, on the same side, looking at the benefit stream, just taking 40% off the benefit stream is probably not appropriate either. And so I tend to try to use an after-tax cash flow with pass-through entities. But I will, depending on if it's a controlling interest, I look at what level of tax is paid at that level of cash flow, and looking at an effective tax rate rather than a flat, upper end tax rate. And so maybe we're making $200,000 or $300,000, small companies, $200,000 or $300,000 a year. I mean, why in the world would I tax affect that at 40%? That doesn't make any sense, even if that's the upper end. And on the other end, I've had really large companies who have millions of dollars of cash flow. And so, yeah, they tend to be on that upper end. But I think it really depends on what is going on with the pass-through entity, what is their actual effective tax rate, and then to parse it a little bit more, it becomes, well, are you using the individual tax rate, are you using head of household? And that usually comes into an argument with marital dissolution valuation cases versus corporate, shareholder dispute issues.
And one way I get around that is I actually will utilize the corporate tax tables to then go through and make the assumption that of what their actual tax rate could be, the effective tax rate could be, taking into consideration both the state and the federal.
Yes.
And then take, a historical average.
You have to be careful looking at the historical average, though, because depending on how far back in time you're looking at,
Right.
We've had different tax breaks,
Right.
Politically and economically, and things changing. If you just look at a comparative chart of how the tax rates have changed over time, it's kind of dangerous to just do that.
And in addition to that, making sure that we compare the tax rate over the same period of time that we're developing the net cash flows. If we're looking at and only taking into consideration the 3 years, we can't take into consideration 5 years of an effective tax rate, making sure to match
I agree
almost
with
the
that.
matching principle.
But in a fair market value evaluation, aren't we supposed to be looking at the pool of likely buyers?
Yes, but
And so their rate's not necessarily going to be at all the same as the rate of the company that you're looking at.
But if you have if you have a small, closely held business that is a pass-through entity, and that is kind of the flavor of the month, right now in this decade, is to have pass-through entities, LLCs and S corps and partnerships rather than corporations. From people who are trying to save money, they don't want to have extra tax returns, and it also depends on the size of the business. If you have a large business, lots of shareholders, that's different. Yeah, the likely buyer is probably going to be a C corporation. So I do
Not
think
just that, it could be a different rate for a person who buys it to operate a pass-through entity.
So
They
I
either
focus.
combine it with another business,
That's true.
or they could have a higher rate themselves because of other
but
income.
They could do that, but in the hypothetical world, hypothetical buyer, they're buying, you pick the business up and you look at it and you value it as is. Now, if they get additional synergistic value from tax breaks that they would have, that's different, because I'm looking at what's the fair market value hypothetical buyer of this company. And if I assume that they're adding it to another business operation or something else, then I'm moving out of fair
No,
market
I'm just
value to
saying
different value.
that's the pool of potential buyers. You have to look at all of them, I think.
True.
Right.
True.
So could you go to the microphone, please? Sorry. But we have the online people to think of here, so. Question.
Hi, Lari and Jim, everybody. I asked Shannon Pratt that. I think we were in Vegas. That's the last time I remember seeing him. But I wrestled with this very issue because there are times when you have enough information to actually plug in a real tax rate based on what they've been paying. And in his kind of summarized response, he said, kind of shook his head, and he said, use the marginal tax rate out of the tables. And that's it. And we didn't discuss it in any length. He just said, just use the marginal tax.
Well, I mean, in all deference to Shannon, and he certainly is the, godfather and king of the hill on all this, but there's a difference of opinions on what to use in these. And for example, neither of you mentioned any of the methodologies. So let's say fully taxing effect and then calculating a premium through either Van Vliet's or Grabowski's or, the other ones. You don't use them.
Nope.
AJ?
That was actually what I used prior to adopting the change in the discount rate, was to use the premium.
So you change the discount rate to reflect a pre-tax
Right,
rate.
right.
Little story about that. I got my ASA in 1994, and of course I had to submit my sample valuation, and I did exactly what TJ said, and they bounced it. Said you can't do that. That was 1994. Things have changed, but in any event. Somebody else had a question. You need to go to the. I'm sorry, but so we can take care of our online people, you need to go to the microphone over there. So okay, so you don't use any of those methodologies. You use Nancy Fannon's approach, I guess, of adjusting the discount rate?
And do I use her to answer the question? I do not know.
Okay, that's fair.
Gil?
That's fair.
All right,
Yeah.
so I use the motorist for the tax guide, my SIC code. Every year he comes out with his guidelines, and one of it is effective tax rates by industry. So I use that to convert the cap rate into pre-tax. So is that the right way to do it? Rather than trying to figure out historically what the effective tax rate is?
Well, I can say with pretty fairly that there really is no consensus on this at all from anybody. I've been fighting this issue for years. And so I also know Pratt, back when this thing really first fired up, I wrote an article. He still owned BB Update at the time. And he was 100% on my side, basically saying that was on a control interest on a pass-through, where I said, shouldn't be any difference between what you do with it, whether it's a pass-through or not a pass-through, if it's a control entity. And I still believe that. But so anyway, let's move on, because we could spend the rest of the night talking about pass-through entities, I guarantee you. in your opinions, both of you, what are the most supportable valuation methodologies?
I'm sorry, say that again,
What are
Jim.
the most supportable valuation methodologies, in your opinion?
Well, I'll take the zinger, it depends.
Can't do that, Lari.
I think the majority of
But actually,
work,
you're right, it does.
it does, but I think the majority of work that I see, I find analysts gravitating in an operating company that has cash flow to any income method that makes sense. DCF if you have inconsistent past earnings or they're not a proxy for the future. And I think a minority will rely on the market approaches, completed transaction, depending on their venue. And the market transaction approach maybe more so in litigation where you haven't explained the process to someone else because it's easier to get a judge or someone else to understand the comparison of buying a house, buying a car with that method versus explaining to them risk-free rate and CAPM, difference between beta and using a build-up method and all that, that you just lose them so quickly in the theory behind it that I think some analysts will rely more on that, whether or not it's, your question was, what is more valid,
Yeah.
a valid approach.
Yeah, that's-
I think that it's the risk tolerance of the analyst that determines, because if you're really doing the work right, you should come up with a similar number on your income approach and your market approach for an operating business. And so then it becomes, did I have enough data under the completed transaction method or the guideline method to rely on the market approach? Which one do I feel more comfortable with? And I think the tendency is to be more comfortable with cost of capital and cap of earnings and DCF than it is the market approaches.
TJ?
Your audience is key. I agree with Lari, but then also my key deal is admitting in front of a whole bunch of CPAs. I'm not a CPA. I have my MBA in finance. And so my key concept is that in a perfect world, all things being equal, exactly like what Lari said, the income approach and the market approach should be the exact same number. In a perfect world. And so if we have done our jobs properly, one methodology or one approach should not necessarily be better than the other one. Now, perfect world, I understand that. So I think that we have to look at what, when looking at the market approach, we have to look at what transactions we have available. And as I indicated to the class earlier today is, if we have garbage in, garbage out, then of course I'm going to look more towards the income approach. And so I think it's dependent on what kind of data I have within the databases and the market approach itself.
I think the market approach can sometimes present some issues that will skew the whole situation. And I think you have to take it into account. For example, some years ago, there were a lot of these businesses that were rolling up. Dental practices was one of them, plumbers, businesses like that were just, and when I say rolling up, what I mean was that they were mostly small individual businesses. And somebody put a public business together and was able to go out and pay crazy prices for these things. By the way, most of those HVAC companies, heating and air conditioning, were another one. And a lot of these companies are back in the hands of the original owners because they paid too much for them. But it caused a problem when you were going to value the company with your methodology, because the only way you could get to an income approach that would equal the market value is if you threw up your hands and said the market value is right, so I'm going to just backfit the multiples into my income flow to get it, which is not the right answer, So, yeah, I think Lari's right. It does depend on the situation as to which methodologies you use. I'm sorry, but.
And I think while he's walking to the microphone, I think it depends, if you do have a roll-up going on, if you see a trend, there's an argument that Rod Berker and I have argued about this before in the past. There's an argument to be made that is fair market value. And so even though it's coming up with a higher number, I mean, if the most likely buyer is in the roll-up industry and you're a good target, then maybe that is fair market value.
And at that rate, it doesn't necessarily become a rule of thumb, which is a different issue, but it is, you have to pay attention to that.
To any
That's-
anomalies that you see. in
So
the
I would
data.
agree that most of the time I like to use an income methodology too, income approach methodology, that when you get market situations like that, like a roll-up, you really have to pay attention to it.
So Jim, do you also use the market approach as maybe a sanity check to the
Yeah,
income
could be.
approach?
Sure. Yes.
Okay, what I find interesting, the approaches we use are attempts to find out what the value is. But whatever it is, it is. And so if there's a value, we ought to be able to get the exact same value from all three approaches. Does that make sense? In other words, if there's a value out there,
You really don't.
because there's different things we do to each approach to adjust it, you know, discount rates, or tax rates, or depreciation rates, or whatever it is. If we did all that fixing, we ought to be able to hone in on the actual value, whatever that value is, and have it the same for all three approaches,
But you-
right? Why should we have an approach that
Well,
gave a different answer?
your asset value is often going to be different.
Because the pure application,
Point is, if it has a value, we ought to be able to measure it with every approach.
No,
and get this-
I disagree with that. There's a difference there. That's why every standard says you have to consider the three approaches to value. Now, if all of them should equal the same thing, then the standards would say you have to determine the value under all three of the approaches. And you don't, because there are many cases where the asset approach being the most common is not applicable. It's also the case in a lot of cases where the market approach isn't applicable. So I don't think that they do come up with the same. And if you would say that, you would also say that you'd have to always have, you would never have an evaluation conclusion that would include different numbers from different methodologies. And you can have that realistically.
What I'm
Like
really-
back in the case where Lari said, Lari or TJ, that in looking at these roll-ups, that it often becomes, Lari said this, it often becomes what the market is and what the value could be. Well, you're not going to come up with the same answer on both methodologies and both approaches. So that's where the professional judgment has to come in.
Oh, I
You have to
understand
say
that.
what's the right value.
I'm saying if there is a known value, you ought to be able to find that value no matter how you measure it, whether it's a measuring tape or a laser or whatever it is, ought to come up with the same value.
I'm not saying that. I don't think that Lari was saying that either. But, yeah.
well, but I think just as a last zinger to you, under the asset approach, if you have a cash flowing company, just the pure application from a theoretical standpoint, it excludes goodwill. It ignores goodwill. We come up with the fair market value of those hard assets, but the method itself doesn't have us come in and value the intangibles and all those other things, assuming it was an operating business that cash flowed. But we know that in instances where you have a holding company, you have little cash flows, that probably the more value you're going to find under the asset approach. And so I disagree. It's actually my opinion that depending on the business, the asset approach may be the most appropriate approach, and you would abandon the other methods under the other two approaches.
Okay, despite the interruption with the music, I've been threatened with my life if we don't stop right at 6 o'clock because I know other people have places to go. So thank you very much. I hope you enjoyed it, and we appreciate your being here. Thank you.